Hi, welcome to a brief presentation on the 2025 One Big Beautiful Bill. I am Vicki Stalnaker, shareholder of JRBT and Director of Operations for Payroll Systems, a division of JRBT. This presentation is not legal, payroll, tax, or HR advice. Please consult with your appropriate advisors for your particular situation. Now, the One Big Beautiful Bill was signed on July 4th by President Trump. It included many tax provisions and also many employer provisions as well. Now, I have a list here, but this is not all of the provisions. These are just some of the main ones that employers will have to deal with. We have tax rates, we have exemptions, child tax credit, qualified transportation fringe benefits, moving expenses, no tax on tips, no tax on overtime, Trump accounts, paid family and medical leave credit, employer-provided child care credit, dependent care assistance, student loans, Forms 1099 miscellaneous and 1099 NEC, and changes to the employee retention credit. Now, we will not talk about all of these provisions today, but just a couple of ones that employers really need to know right now. So the first one is no tax on overtime and tips. This has been talked about for a while, especially with this legislation moving through with various changes. This is retroactive back to January 1st, 2025, and expires December 31st, 2028. One thing to remember is that when you pay overtime and tips to employees, it is still subject to taxes when paid to that employee. So it is taxed for Social Security, Medicare, federal income tax, as well as employer unemployment tax. So where the no tax comes into play is that employees will deduct qualified overtime and tips on their individual tax returns. However, it will be subject to specific limits and guidelines. So you will notice that we use the terms qualified. So qualified overtime means that it meets those guidelines. Not overtime may be eligible that is paid to an employee. One thing is it is limited to the premium portion. When you pay an employee time and a half of overtime, only the half portion will be potentially qualified as a no tax item. And it is also based on FLSA guidelines. Now, qualified tips as well, once again, that word qualified, will be limited to specific occupations and only include voluntary tips, not mandatory payments. Now, one thing that we don't have at this time is guidance, additional guidance from IRS of how do we handle these items, both of knowing what is qualified, as well as how do we handle for retroactive all the way back to January, since this legislation was finally signed in July. Also, we need to know how to report it to the employees. Currently, tips are reported on the W-2, but we now have all the tips and potential qualified tips. So how will that be reported, as well as the overtime amounts? They will be reported on the W-2. We just don't quite know how yet. In addition, we will have possible Form W-4 changes. Since the employees now have pay that will not be taxable to them, how does this affect their W-4 for federal income tax that is withheld as part of payroll going forward? Now, some other items that will affect employers and employees is several exemptions that were either established or made temporary during the TCJA, which was a prior legislation. Some of them were made permanent now. So the first item is personal exemptions. Now, you will remember back in 2020, we had to start using a new W-4 due to the TCJA tax legislation changes. But we were still able to allow employees to use the old version of the W-4 as well, as long as they were still an employee with your business. So there may be a chance that with personal exemptions going away due to the new legislation, they are permanently gone. It may require all employees to use a newer version of the W-4. So stay tuned for more guidance on that. Another item that was made permanent were tax rates. So our supplemental wage rates are going to stay at 22% and 37% for the supplemental wage payments through payroll. Another item is moving expenses. So a long time ago, moving expenses were allowed to be non-taxable to the employee in specific situations. And the TCJA came along and made those moving expenses taxable again. Well, now they are permanently. The only exemption is for military. Now for your 1099 miscellaneous and 1099 NEC. The reporting threshold for that has been $600 for a long time. But starting with payments made in 2026, so starting January of next year, that reporting threshold will increase from $600 to $2,000 and will be subject to inflation adjustments beginning in 2027. So the last item I will talk about today in this brief presentation is the Employee Retention Credit. So IRS will not process any ERC claims that were filed after January 31st, 2024. Now, if you remember, IRS issued a processing moratorium that was placed in 2023, where they were trying to stop all the fraudulent returns that were being filed at that time. And then they extended that moratorium out to January 31st, 2024. Now, this stoppage of claims was part of prior legislation that did not pass. So many businesses did not file any after January 31st, 2024. But if you did, just know IRS may not process that claim. It also extended the statute of limitations. So for Q3 and Q4 2021, the statute for having audits or assessments looking back at those ERC claims was extended to 6 years. For 2020 and Q1, Q2 of 2021, those statutes still remain at 3 years. So now with this legislation, it is very new. We are still waiting for more guidance from IRS on how to handle a lot of these provisions and how they apply to employers and also to employees. So please stay tuned for updates. We will have more videos and we will probably have extensive videos on some of these aspects once we know the reporting requirements. Please stay up to date with our newsletters at payrollsystemsjrbt.com and also at jrbt.com. Thank you.